Okay, I think we're ready, and everyone who was about to late is late basically. So, hello everyone, I'm Dominic Stampiani, and I'm the CTO of Finance. So maybe I will begin from explaining a bit about myself, my own experience. I'm into crypto for the last 7 years, after which I was being here as a private investor, also as a employee in certain crypto-related companies. So always I was like a kind of approach and see to details about certain problems that most of the project approach during their journey. Um, the possibility to work as an employee in a certain crypto company also gave me the opportunity to see how certain projects try to avoid certain mistakes that they do that are not visible from the investor side. So overall project is quite good, but at the end it's not okay. I think that's the biggest problem of these cryptocurrency products, that they don't give you any kind of value at the beginning, which leads to problems related with the any possibility. And the first and the most important question: what do you hold this coin? Um, I always hated investing into coins that show only the vision. I was also tired of the projects that wanted to create another kind of marketplace or another kind of Web3 world something. You know what I mean. And also all the AIs that are quite interesting these days, but still most of these will just fall, and they're just short period projects for, yeah, short-term investments. Um, Based on my own experience, either as an investor or as a person who worked in certain projects, I personally am also a kind of a person that is really analytic. I love finance. Also, financial engineering is kind of my passion. I wanted to create a company related to the common monetary and financial market, but you can see, which is I feel clear, that most of the niches these days has in the normal common financial markets is really limited, because you need to rival with big equities, with private people and bots. So it seems to be really not worth your time to try to rival on this kind of market. So I decided to change to cryptocurrencies. That's why Dividend was created by me. In simple words, one token, diversified portfolio, which means that Dividend is a kind of crypto ETF or an investment fund that should take part by simply owning the DVE token on your wallet. But we will get to that further. So basically, dividend we base on four main pillars. The first one is diversification, which is quite simple to explain. Many people that get into crypto don't have that much money to be diversified enough, which of course is a huge vulnerability, because your wallet is has a bigger risk of just lose money. Okay, if you have 10 or 20 projects, it's harder. But if you have limited capital, you don't have enough money to be as diversified as you should be, especially if you're talking about fee-free liquidities, which is the main part of the today's dividend treasury. The second one is passive income, which is also related to the liquidities. This simply means that no matter what amount of money you're going to invest in dividend, you're going to get a passive income daily paid out in BNB, especially not in our token, which is, I think, quite, yeah, I think it's a quite important, because usually projects like this just give your own token as a APR, as a kind of staking reward. But in long term, it just makes a hyperinflation on your own project. the thing that we want to avoid, right? Unfortunately, most of the projects these days and back in history in crypto, they thought the same way. So they were more about giving your own token and having the hyperinflation stuff in order to, access to more investors by this kind of marketing thing. But at the long term, it was not a good solution. And usually these projects die their nature way. Yeah, the time efficiency. I think that you, as a person on the other side of the screen, have your own company, I mean, a business, or you are employee for some other person, or you have your own family that you want to take care of. All of these things consume your own time that you can spend on managing your own wallet and on investments. And I think if you don't have that much money in crypto, it's also not worth your time at all. So we basically take this problem out of your bag to us. We have a team of people that specialize in DeFi investments and crypto investments that supervise and actively manage the wallet on a daily basis. For exchange, in exchange for a small fee, which is mentioned later, that I will get back to that. And at the end, cost efficiency, which is also quite easy to explain. If you have, let's say, 1,000 USD as your portfolio, if you want to make a swap or an Ethereum, or you want to, let's say, use the version 3 of liquidities and automate them, it will cost you a significant percent of your position's value. So for most of the investors, these kind of solutions just don't make sense. But on our side, we have many of people like you that invest a small amount of money, and because of the pool effect, uh, your position in a treasury is part of the whole treasury. But if you manage the whole treasury's valuation, the gas costs or any other fees are just insignificant because of the amount of money we manage. So you just, save money on any additional costs regarding the gas and stuff like this. I think it's pretty cool overall. Okay, I'm sorry, we're back to the topic after a small interruption. Invest like a whale. Easy saying. Imagine that of these companies, venture capitals and private people with big portfolios, they have access to the best deals in a crypto because of the money they manage. They're able to invest in a certain projects very early, which of course require a high ticket of the initial investments. But on the other hand, your outcomes are way higher than if you going to invest in a phase that you are able to in most of the projects. I think a good example is a Sand token of the Sandbox project that back in a 17, if I'm correct, maybe 16th, certain companies were able to invest into Santa's token as the really first pre-sale, and due to the distribution, the unlock of the vested tokens in the 20s led to basically gains of 200x as a average of these companies. So imagine that you can do it with like $1,000, 2,000 bucks. But we as a company, if the treasury grows, of course, we would be able to do things like that. So we will be able to uh, take advantage of opportunities like this in the future. So basically, invest like a whale split into three more complex points that start with taking every project under dividend brand, which simply saying is that we want to manage the treasury the way that we can build our own sub projects and sub companies under the dividend brand, so that people who own our tokens are going to also be our customers in a next investment made under the dividend brand. What do we consider as a dividend brand things? For example, I was thinking about creating a loan protocol of which revenue is going to be split by half this sub-project tokens owners and the half by the dividend. So, it's like a growing business and also a part of the huge diversification and the cost efficiency because usually people are not able to just build a project like this by themselves. The second thing, which is the private seed round, I think that I've already explained this on the by the example of sand. So the next point is freezing capital long term. It also relates to the private seed round access and creating brands under dividend. So to explain this more complexly, freezing capital relates to the money that you need to freeze for a certain amount of time in order to get this high revenue. So still referring to the sand example, these companies that bought these tokens for really huge figures during the 60s and 70s, they had to wait many years to get any amount of money out of these investments. Freezing capital means totally freezing capital at all for a certain amount of time. So as a individual investor, you are usually not able to freeze capital that long, and even if you might be, that can be too risky decision to be made. And we understand that in dividend, so we kind of also take this worry from your back because because you don't freeze capital, we freeze capital. So on your side, you have exposure for investment like that, but still you're able to sell your coin anytime you want, basically. So there is no freezing there is no freezing on your side, but still you take advantage of a solution like this. Dividend all-in-one solution. Oh, let me fix the camera first, so everyone can see everything. Sure, great. So dividend all-in-one solution. This chart is a little older, but I think it also showcases of these aspects by why not by why certain projects don't have attention and don't have that attention that they used to have in the past. So let's begin with the Commonwealth, which is the first project in our bracket. Commonwealth, simply saying, is something similar to dividend, but it's more decentralized. You basically buy the ready vault with the potential investments inside. People can just vote on what they want to invest, but they're still tokens only that you just invest long term. You're able to withdraw your money anytime you want by selling your position, unfortunately, to the unliquid market. So that might be a little problem. But still, Commonwealth makes you able to earn passive income if you stack their own tokens and the money is not generated out of their own token, but it's just a kind of revenue that they generate, share with their holders. The next point, the buybacks and burns, which is also like important part of the dividends treasury and dividends ecosystem. They don't have mechanisms like that. So overall, token don't have any, buying pressure at all, made by the team or by the ecosystem, of course. The next thing is early investing phase, which is basically the same that we've talked in a previous slide. They give exposure like this, like I said. The next one is the diversification, which is also true because you have a basket of certain tokens inside that you invest in. But the important thing, this portfolio is not managed actively. You just buy it and hold it, nothing more, which on one side maybe for some people a good opportunity to have like the same basket of tokens, but on the other side, I feel like crypto market overall is really volatile, and people need to take advantage of the occasion that just appear. So I feel that any kind of wallet these days must be managed actively. Unless it's like only BTC or Ethereum, stuff like that. But if you um, want to leverage your portfolio by certain altcoins, you need to manage it actively. So the next thing is Uniswap V3, which in this exact example is just V3 liquidity as a farming, which showcases you like this passive income only. Out of the advantages we also implement into the Dayvidende ecosystem. So instead of managing your own position, which might be quite still, which might be quite um, can't find the word, sorry. Mm, risky. That's the word I was looking for. So basically, it might be quite risky, and because this kind of technology is quite advanced, I personally take advantage of this technology for the last 2 years. I manage my own portfolio, a few private people's portfolios as well, not only the company's one. And what I can see about it is that you can see your mistakes after certain amount of time. So unless it don't last for like month one or two, you won't see your own mistakes because of the complexity of this technology, but also how uncharted it is yet. So the next company, as an example here, is a Sphere Finance. Sphere Finance, simply speaking, is a also a kind of crypto ETF, but this company focused on creating their own projects under Sphere Finance brand as a main product. So as you can see, the only elements that of the David's ecosystem they have is buybacks and burns and diversification. Diversification because, like I said, they built a different kind of projects under Sphere Finance brand, and they use buyback and burns as a kind of giving back value to the token holders. So instead of just paying people in certain token, they buy back their own token from DEX and burn. This kind of solution makes sense, and it was, I think, one of the few and the most popular ways to give any kind of incentives to your holder previously. But as we know, it changed. So still, I think like the whole ecosystem needs a couple more parts to be sustainable long term, as we do in Dividend here. So passive income, buyback and burns, early phase investing, diversification, active portfolio management. Okay, so another slide, 30% APR in BNB. What stands behind this phrase? And why BNB? So let's begin with the answer for the second question. BNB is one of the biggest ecosystems in the crypto. It's it's founded by Binance, as we both know, as we all know, I hope. Currently, BNB as a token is totally deflationary. They emitted all the tokens, which is 200 million, that they just burned them via quarterly paybacks made by part of the dividends revenue. So it's basically the the traction on a BNB is dependent in a huge part of the Binance exchange, which is on one side risky because it's a step back from the diversification that we require from blockchain, from crypto. But I feel like still BNB because of the trust. I mean, it changed a lot these days, but still, it's a huge exchange that I think is going to last long. So it's a really good token to keep in your wallet, also as a kind of store of value, right? This APR is paid to every holder directly. Uh, I mean, you don't need to stake any tokens. You don't need to stake DV tokens. You just need to have them on your wallet, and you're awarded with the BNB 30% APR fixed, which is yeah, basically paid every block, by piece by piece. Easy saying. Um, why this kind of distribution? So, like I said, I don't want to give people the shitty token that don't have value. So I wanted to just give them that token that, yeah, that they want to hold long term. Um, why 30% APR? Fee-free liquidities that we invest in are a kind of technology that is yeah, I mean, you can make money on it if you know how to still. So it's still like a safe figure here. These days, but I can say that most of the solutions that we invest in give us around 50-60% APR. So still we have a room for short-term cuts. I mean, not for short-term cuts, for sustaining the APR with no cuts required. But if it is, I think we'll be prepared to save the protocol and the price if it's necessary. Um, yeah, so basically that's all about BNB here. The reserve that works. So from dividend, the revenue we generate from our investments is split into certain parts. 30% is fixed, get to the people out of the money we generate over it. It's split equally. One half is used to be reinvested into our protocol, but the second half is used to just burn our token. I think that's clear. In a long term, in a dividend 2.0, we want to change it slightly. So from from the hmm, from the revenue we generate, yeah, from the revenue we generate, part of it is going to be stored in a BNB's treasury, exclusively for Daveland, where I mean where the BNB is going to be placed exclusively. Um, as a just long-term treasury value, right? So these tokens, they're also going to work for the holders and for the treasury by Binance Launch Pools and Launchpads. We gained access to that basically on chain, so it's not required from us to, you know, get to the Binance, get the verification stuff. We can do it all everything DeFi, and still take advantage of solutions like this. So that's how we plan to grow this kind of treasury. Increasing revenue, decreasing supply. So another important part of the dividends ecosystem, which is a also additional leverage, how people take advantage of investing into the dividend and make more DVE or just make BNB as an extra income here. From the revenue, we plan to, yeah, like I said, like I said before, that were the plans for Dividend 2.0 for the first phase of distribution, which is still right here. I'm sorry, it's also about Dividend 2.0, but it's called similar, so I hope it's understandable. So here, from the money we want to use to buy bucks and barns, which are going to be made on the Duke distribution phase, Pancake Swap pair, and after we introduce order book, which is another place to trade our token. You know, now we want to make people able to either use PancakeSwap as a place to swaps or order book. And the difference is that you don't have slippage on the order book. So it's easier if you want to, you know, just cash out your crypto or just have a position to make more money by the arbitrage. So getting back to the topic. As you can see here, from the money we want to use for buybacks, it's split into halves, two equal halves. one for LP buybacks and second for the order book buybacks, the same amount. And here, DVE that we bought back from the LP or from the order book is simply burned. And when it comes to the liquidity, to the fees we generate from the certain liquidities on the LP or on the order book, because in both places the revenue, I mean the fee is the same, which is 1%. The DVE is also burned, but the BNB is just deposited into the treasury. So yeah, even when it comes to the fee from our own LPs, this value is also placed somewhere to just grow it. Okay, so leverage income by arbitrage, the topic that I begin in a previous slide. So basically here, how can you make more DVE or just earn some BNBs? Because our ecosystem is planned this way, that from the revenue we generate as a dividend, 30% is given to the holders, of course, up to the value which is the surplus of this. Half is invested and half is used for buybacks and burns. This particular solution creates an opportunity to make some money by arbitrage because, for example, currently our treasury value is 30,000 USD. The LP of DVE to BNB is 5K around. Because now in treasury we want to keep the dividends per DVE to BNB as a part of the dividend treasury, because this way it grows accordingly to the sales of the tokens. And now 20% of the whole treasury is just a per BNB to DVE. So getting back to the topic, we make buybacks from this exact liquidity pool. So if you make a buyback, the price just rises up. So unless someone make a sale of the DVE on this pair, the price constantly goes up. You can see on our chart that we had some moments when people were able to take advantage of arbitrage and sell DVE at even two dollars 50 cents, even though that you are always able to buy this token at our website for $1. So it's like 150% revenue, which is quite good just for the arbitrage. So you just need to have your own tokens on a wallet, and when the price is pumped, you sell it, buy it back from Dayvidende website, and yeah, the profit is done, man. So the second opportunity is a fluctuation of the BNB token to the USD value, because DVE is then priced in BNB first, then in USD, is instead of USDT as a part of the DVE liquidity. The fluctuation on the BNB valuation makes it possible to have occasions to either buy DVE under $1 because of the falls, or just like in the same previous example, just sell BNB on LP and buy it back on up and make a profit. Yeah, and of course the another arbitrage opportunity here is option to is the same as the liquidity pool, but with the order book. So all of these free sources how to get the DVE or sell it. You can take advantage of arbitrage between all of these and just have more DVE at the end, which I think is quite a good deal. Dividend 2.0. So basically, here is a breakdown how the treasury in Dividend 2.0 is going to look like. I think we can begin from the top, which is long-term holding. Here we consider tokens that we're going to hold long-term and stake in order to grow their value. Here we are talking more about blue chips like Kcoin or TenFi NFTs. Basically tokens that you buy for cheap during bear market that don't give you that much APR. We're talking like 5, 10, 15%, but their biggest advantage is that they are safe. So you just hold these, and if the money goes up, also these goes up. So your ROI also goes up. That's our plan. Physical goods. Here we're talking about physical goods like real estate, for example, that you can buy, and the money, the revenue that comes from this estate is just paid like the another stream of income that goes to the token owners. Staking and farming is what we do now at most, which is with free liquidities and staking of certain tokens, but we want to hold them speculatively. Another part is mining, which is 25%. Here we want to take advantage of opening our own sub-project that is going to take care of mining in a right jurisdiction, in a proper country where it is, profitable, because it's not in most places, but in certain places it's a really good deal still. So another one is the BNB treasury we talked before, and stablecoins. Here's a position that we want to just have in a wallet, and in an emergency or in a moment of big volatility. That's a position that is going to balance all the positions you can see here. So if certain part of the portfolio is going to go down or going to go up, we're going to balance everything. Designing this, I wanted to create a portfolio that is going to sustain no matter bear or bull market. We know that it's going to fall I mean, the whole portfolio, yeah, it's going to have like pullbacks, and runs up, but I think it's common way. But overall, the point is to still take care of the DVES token value and create a treasury that's going to grow long term. Long term, we're talking about 5, 10, 15, 20 years. That's why I don't invest into that much speculative assets here. Also, when it comes to Dividend 2.0, most of the current elements of the ecosystem are going to change, but we are going to explain it in the future. Proof of treasury. So here is the explanation how we want to approach to liquidity in a Dividend 2.0. Basically, we want to introduce our own DEX with custom fees that are going to work like this. When the treasury value of the dividend is the same as the DVE market cap right here, the buy-side tax stays the same as 1%. If the treasury decrease in value, the buy tax rises. So it makes a selling pressure for the DVE token to keep the same valuation as the treasury. This way, introducing this kind of algorithmically driven fees, it deletes the inequality in a treasury value and DVE price. Because these days, if you see all of these ETFs, their valuation and the value of the stocks inside might be different. That's how we want to avoid it, and that's how we want to more like drive price and tell people that, hey, this token should be worth less. So yeah, if you wanted to sell, that's a good moment. But if you want to buy, you should wait a little. I think that's a good explanation. Even though you can buy a token, you will pay a significant fee that overall is is paid back to the treasury. So even though you like buy the token, the price is going to be equal at some point. And the same thing happens here with the buying with the growth of the treasury, but the sellbacks appears to be higher here. Yeah, I think that I hope that makes sense and everything's clear. So getting back to the basically last point of our presentation here is what we more like the most, I hope, the affiliate system that you can just take advantage of and make more DVE by sharing, get more DVE by sharing. How it looks? Let's bet that you refer David is a project to one of your friends. He buys DVE at $100. So he gets 100 DVE, right? You, as a first line affiliate, get the 10 DVE back as your, how to say that, just as your award. Yeah, I think award it's a good word here. So you got awarded by referring a project to your friend. If this guy refers the project to another one, he gets 10 DVE. But still, you, as a second level affiliator, gets 5 DVE as well. Okay, if the same situation happens once again, but for the person P, so he refers to person C. In this scenario, person B gets 10 DVE as an affiliation. The person A gets 5 DVE, but you at the end gets 2.5 DVE. You might think that that looks like a Ponzi scheme and stuff, and that's true. Usually, companies usually companies like that use solutions like that, but I feel honestly that this kind of marketing is really good and makes sense if you're still able to make more revenue then the amount of DVE will be distributed. What I mean, if you refer DVE to someone else, the tokens are not given to you just like that. Instead, they're vested for 365 days and distributed every block on blockchain monthly. Why is that? The answer is simple, because if someone will, um, it's more like you probably know that we don't um, verify anyone if someone gets DVE from our website, unless it's a buy under $1,000, which is clear. But it's limited up to a certain wallet, not a certain account. So the verification here is quite tough. That's why we wanted to avoid a situation that someone can just print these DVs. So in this scenario, the maximum inflation that we can meet is 70.5%, which is like taking advantage of every level of affiliate program by yourself. It's only for one year, of course. So mathematically speaking, on our side, everything is the same business-wise. Okay, so I think we're done here, at least with the presentation. So if any questions appears, I'm ready to answer. So here's the dividends treasury. As you can see, it's currently just one position. It's going to, of course, grow in the future. Now you can see that the valuation is around 29,600 bucks, which is quite okay, because from the very beginning of our marketing, it grew by 20K in basically less than a week. For a project like our and for the marketing, for the amount of marketing we input here, I think it's a quite okay score. So we can track the revenue back up to 1 year. but I prefer to begin from this place here. Oh, this place, which is the price of the exact part of the crystals vault. So basically, when this vault went live, the part the price of one, let's say the vault's unit was $660. Now it grew to 750, which is a 13%, 13.6% rise from basically the 27th of May. So in a couple of months, our treasury growth almost by 50%. Moreover, we still were able to pay people 30% APR for this time, and almost 500 tokens were burned. So, and also some of these are in liquidity still. So overall, I think like the whole values of treasury, if we combine it with the money we used to buy bucks and the money we used to pay people that own our token, would be like 20% or even more, realistically speaking, in a few months. So it seems like a fair deal here. You can see that the valuation of the valuation of the vault in BNB tend to fall, which is I think like a normal thing, because it also shows what the percentage here was the I mean, in which percentage the growth of the vaults part was made by fall of the BNB. I think it's a correct explanation, because during this time just BNB rose in price. So this vault in priced in BNB just fall. Yeah, I think that's pretty clear. So here's the vault. Of course, we want to grow it in the future. If we cross 40K in sales, we're going to open the same vault on either Base or Arbitrum, one of these. So we're going to also diversify multi-chain here. Yeah. Besides the growth of the treasury, I also managed to develop our Telegram group. Here's our Telegram group. So basically this group started, we started to develop it after publication of one of the Polish influencers video about Dividend, to also onboard better Polish users. So starting from the top, here's the general chat. You can see all of these buys of DVE token that were done. We track it from this place. Moreover, the second bracket is tracking of the DVE tokens that were burned. You can see here the details regarding the swap, also the transaction ID of the exit swap, and the transaction ID of the sending tokens to the burning address. Here's a bracket I am currently working on, which is a tracker that tracks DVE sales on our website live. So it's going to be finished, I think, till the end of this week, I hope. The next bracket are airdrops. We usually take advantage of the airdrops. What I mean, so let's break it down. Like after this call, during this call at the end, we're going to create a AMA. A Zoom with Zoom AMA. I'm sorry, I'm not tired. So basically, every Zoom, which is going to take place every week, every Thursday in English, and every I forget the day. That doesn't matter. We are here on the English call, so that's the most important part. Every Thursday, and after each Zoom, we're going to give away some DVE. Random person gets 10 DVE, and everyone gets one, like you can find here. So there's going to be a like the common aspect and the thing that we're going to do on every call. So if you want to get someone here to hear more about Dividend, ask more questions, or just learn more about updates, it's a good thing because you won't go away with nothing if you get. I feel like it's a fair deal. Here we have the Polish group, affiliate code, place to post affiliate codes about everyone, FAQ, support, and all of these official links to all of our social medias and stuff. LinkedIn is going to be put here really soon. Okay, so yeah, I think it's all about the protocols here. I think it's the last moment before the airdrop. If you want to get an answer of any of these questions. So a couple minutes to you. Okay, I feel that no one has questions, so no further questions. So at this point, I thank you very much for attending the call, Zoom. If you will have any other questions, after that, you can just contact me on Telegram. If I'm not sleeping, I'm always by the phone or computer. So feel free to DM me anytime you want. And yeah, see you next week.